And joining us now is Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Now, Larry, let's start there with the oil price at the moment and how it's been affected by the Iran sanctions. Talk us through that, and do we see the global supply tightening a lot?
You know, I think it's a lot more than just Iran. I mean, a big part of it, but today's action was really it was a risk-on day. The stock market 10 points away from an all-time record. People becoming less concerned about the trade issues with China. But over the weekend, it was pretty a full calendar. I mean, it's Saturday. We heard that the Venezuelan president, Maduro, was allegedly a potential attack from a drone. We had war games being played in Iran. And then you had demonstrations, civil strife in Iraq. So all that combined, it's going to put a tailwind into the price of oil short term. And I do believe still that that's short-lived.
Okay, so it's short-lived. So we see that supply increasing in your view, or more from the demand side?
You know, I think, yes, we'll see more from the supply side. I think the log jams in the lower 48 here in the United States will free up a little bit. But I think it's more of a demand equation. I mean, right now, oil continues, the demand growth is 1.5% a year. That's like 1.5 million barrels a day. I just can't see that persisting, especially when you look at a 10-year average of oil demand growth, usually around 1.25% at most. This demand has exceeded my forecast by many, many months. But I just think at some point, when you look at the divergence of industrial production numbers, GDP, and PMIs, I just cannot see that persisting.
Okay, so looking at how China fits into this, obviously we were talking earlier today about a bit of a deleveraging going on in China. Whether it's a deleveraging or the trade tensions, we see the growth is starting to slow down in China. How does that affect oil demand and furthermore, you know, the price around growth?
Yeah, I think it's, you know, partly to my point that you know, when we see leveling off of GDP, now obviously China is still growing at a good rate, just not as hot as it used to be. There's some fiscal stimulus going on in the country that will help, but I do think it's just natural for demand, oil demand actually, to just top off, as it were, to stop growing at 1.5%. Also, we have to add to a lot of the emerging markets, oil is well over $100 a barrel. So that's one way to stop higher prices is to make the prices higher so people stop buying it. So that's something that not many people are talking about, but a lot of the emerging markets are suffering right now with the prices of oil.
And let's look at the USD, and obviously against the yuan at the moment. The yuan has been dropping for a while now. Where do you see this the driving motive behind that, and where's the US dollar in this play?
Yeah, that's a great question, and who knows where this will all end up. But I do think that China is, like, you know, kind of in a pickle because people are claiming that they're depreciating the currency. That's not going to be good for them. It's definitely going to, you know, exasperate capital outflows in the country. Should they raise rates and tighten financial conditions, that's not good for the country either. So I think there's a lot that's going to play out, and I do think, as always, the RMB and the U.S. cross, you know, overruns, and I think it will surprisingly stay in a very narrow trading range until this gets figured out.
I can't help but think that coming into the end of earnings season that we're possibly going to have less attention being gained by companies that are coming out with either really good results or misses, that there's going to be more focus on the trade tensions and the growth around the world and the prospects rather than individual companies taking all the spotlight. Do you see that US-China trade tariff war coming a lot more into focus?
You know, actually, it's not, surprisingly. And it's so funny that you mentioned that, because I think you're spot on. I mean, the market wasn't concerned with earnings until earnings was almost over. And now, like, we're assuming $178 a share for the S&P 500 in 2019. That puts the S&P 500 at 16 times multiple. It's not crazy. And relative to government bonds, it's still, you know, a value. But that being said, that the trade talks the fears everybody had seems to have gone into the rearview mirror. I guess it's not headline shocking news anymore, and the market's gotten over it, perhaps thinking that it's not going to be as bad as feared. And if that's all true, then my mind would be the best value right now would be Chinese equities, given the Shanghai Composite down 16% on the year, even though it rallied almost 3% last night.